Hi, I'm Ben and welcome to Motivation to Invest. Our mission is to motivate you to invest for your financial freedom. Whether that means escaping the 9-to-5 drudgery or just improving your quality of life, I'm here to help you by providing you with valuable investing tips and strategies. Due to the recent global issue, which shall not be named, the economy has stalled and the stock market has taken a major hammering. Is the world about to end? Or is this the greatest time to invest in some bargain stocks? If you believe, like me, that the economy will recover as it has done so many times before from previous recessions, then now could be a great time for you to start investing. The FTSE 100 has took a real hammering recently due to the global pandemic and the subsequent economic implications. Barratt Developments is one of the largest residential property development companies in the UK. It has a network of over 30 divisions and was founded back in 1958 as Greensitt Bros before being taken over by Sir Lawrie Barratt. Barratt's share price plummeted by over 50% from its February high due to this latest stock market crash. However, this stock was one of the first to rally by over 35% in just a few days. This suggests that the property development industry and Barratt Developments could be one of the first FTSE 100 stocks to spearhead the FTSE 100 recovery. Could this be a great opportunity to get yourself on the FTSE 100 property ladder? In this video, we're going to find out. I'm going to deep dive into Barratt Development stock and inform you if I personally have invested into this business. Let's dive in.
Coming in, flex, I just wanna win.
Before we get started, go ahead, smash that like button and subscribe if you haven't already. Be sure to turn the notification bell on, that way you'll get notified when I release future videos and stock picks. It's good to be first on the scene when an interesting stock is at a great price. Central banks from around the world have unlocked trillions of dollars worth of funding to make sure the financial system stays liquid and doesn't collapse. So far, their measures seem to be working. Property development companies are going through a tough time right now, with Redrow, Berkeley Group and Crest all scaling back or cancelling their dividends entirely. Barratt Developments followed suit by cancelling its dividend to give itself 100 million in cash. Barratt Developments also suspended all financial guidance and shut down all offices, sales offices and construction sites. They have also exercised capital discipline and paused all land purchases and unnecessary capital expenditure. However, they are continuing to pay suppliers and subcontractors. So how did these property development stocks perform during the previous financial crisis in 2008? Well, the FTSE 100 property stocks are actually in a much stronger position than they were back then. According to the Barratt's investor statements, we are in a position of strength with a robust balance sheet, a highly skilled workforce and an experienced board. The question is, when will the property market recover? Are we set for a double dip stock market crash as some analysts have predicted, or are we set for a more healthy V-shaped recovery? Also, many consumers may be shaken by this incident and not wish to purchase a brand new property within at least the next couple of years. This is bad news for any property development company, despite the rock bottom rates on mortgage interest. However, as the UK housing market is very resilient and at its core there is a real excess demand over supply. This means the rules of supply and demand will reign true for Barratt Developments, as people will always need housing. Deep diving into the stock here, we can see that Barratt Developments is trading at 63.1% below its fair value, which is incredible. Its earnings are forecast to grow at 3.81% per year, and its earnings grew by 3.1% over the previous year. Looking at the risks, we can see that it has a highly volatile share price, which would be expected due to the recent global issue. But in terms of the other risks, Barratt Development has passed those, which is great news. Investigating further, this is its valuation here. So as we can see, this software has calculated Barratt Development's share price to be worth approximately £12.77 per share. So the current price is £5.18 per share. So according to this software, it's approximately 59.4% undervalued. So that is significantly below fair value, which means you get a margin of safety when investing into this stock, which Warren Buffett always suggests. Looking at the PE ratio, it says it's good value, 6.4 compared to the consumer durables industry average of 8. Now, I wouldn't call this a consumer durables industry, to be honest, but I still believe it does have a good PE ratio. There you go, compared to the UK market, it's 13, and this has got a ratio of 6.4. So I'd say that's more of an accurate one than the consumer durables. PEG ratio, it says it's poor value in the PEG. Price to book ratio, it's same as the industry there, as it says. Future growth, 3.8%. Future return on equity, it says it's going to be low, which isn't good. Historic annual earnings growth, 11.9%, which is great over the past 5 years. Return on equity is good, like the company is higher than the industry. Return on assets is very good. Financial position analysis. Financial position analysis. Now, this part is really important, and before valuing any company and investing into them, you need to check the levels of debt the business has, and especially short-term free cash flow if there is a short-term issue, for example, this global epidemic. So as you can see, in the short term, Barratt Developments has a lot greater assets than liabilities. So it has 5.76 billion in assets and only 1.5 billion in liabilities. This means that in the short term, this business has plenty of free cash on hand to cover all of its debts easily. In the long term, it also has greater assets than liabilities. So we've got 2 ticks there. Great. Dividend, 5.89% forecasted dividend yield, which is also fantastic. Experience management. Now, insider trading, this is where we need to be careful. So we need to check if there's been any major sell-offs. So there was only been, during this recent issue, one on the 13th of February, 3.6 million. Stephen Boys, who's that then? Let's see who that is. So he's the Deputy CEO and Executive Director. So it's not good to see insider trading like this, but 13th of February, there's not been a major number of sell-offs. So I think if the insiders knew that there was a real issue with the business, then I believe there would have been more sell-offs from all the members of the board. And also 13th of February was before the pandemic actually hit the UK. So perhaps this was something to do with his personal position. So he sold at £8.42 a share. Let's see what it is today. Just remind myself. So it's £5.18. So he was correct in selling off then. Overall, Barratt Developments is in a healthy position to weather this storm. Its balance sheet shows it has plenty of cash on hand to pay all of its existing debts very easily. The company's experienced management has also acted fast. They have exercised capital discipline by cutting any unnecessary expenses. As the economy recovers, the rules of supply and demand will reign true. There is still a shortage of housing in the UK with an ever-growing population. People will always need housing, and as the UK property market recovers, I predict that Barratt Developments will reinstate its 7% dividend, which is great news for investors. I predict Barratt Developments to be one of the first stocks to spearhead the FTSE 100 recovery. So I did purchase shares in Barratt Developments. I would love to know your thoughts on house building stocks in general. Do you predict a quick recovery for the housing market, or do you think it'll be a long, more sought out process? Please drop your comments below. Be sure to check out my other videos where I analyse 5 stocks I purchased during the previous stock market crash, which has seen me up by £1,000 in just 7 days. Now, as a long-term investor, this increase doesn't really make a difference to me, but it's still nice to watch your portfolio grow over such a short period of time. This suggests a possible V-shaped recovery from this recession. I also have a video reviewing the free trading apps which make it really easy to get started investing. I've included a couple links below which will give you a free share when you sign up. But remember, on this channel we don't give financial advice. So please evaluate the stock yourself, research it yourself, assess your own investing goals and your own budget before investing into any stock we mention on this channel. And if you enjoyed this video, go ahead, smash that like button and definitely subscribe. See you next time.
Coming in, flex. I just wanna win.